Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello, hello. This is Abel Pacheco. I'm your host for the Five Talents Podcast. We are super excited today. We have an amazing guest, Mr. Matt Picheny. How's it going, Matt? How's it going?
It's awesome, Abel. How are you?
Man, I'm doing excellent. Thank you very much for joining. I'm humbled. I'm appreciative. I'm super excited for our listeners. They're going to get a lot of value from the show. I know already. Having a little bit of, just knowledge of your background and your experience, and even our pre-conversation, our listeners are going to learn a ton. So before we get started, let me at least, for everyone listening, give a little bit of background on Matt so you have an idea of like why we should be really taking some notes here. I think it's going to be a really valuable show. He's invested in over 5,000 apartment units, so apartment doors invested in, and he's active and also passive. So for the passive investors listening, you're going to learn a lot on, how he does it, how he's operated. And then for those new general partners, you're going to learn a lot about repositioning multifamily communities, because he's got a really big, kind of mission or why to improve communities and also help the investors along the way. So he's got 15 years of experience in property analysis, financing, acquisition, construction, operations. We're going to learn a bunch. He's also a licensed real estate agent, Fannie Freddie Mac approved buyer. He's got that done. Forbes Real Estate Council member. I mean, Matt, you've done a ton. And then also Boston University, kind of graduate. And I've heard on a previous show, man, you were an actor in your background in the past, a digital marketer. I mean, you've got just a tremendous background, not only commercial real estate, but also your personal life, man. So why don't you tell us a little bit about who you are and what you're doing today? That'd be awesome.
Sure. Well, I mean, I think you gave a really good, background information there about who I am. And also you touched a little bit about, what I'm doing and why I'm doing it. For me, I look at investment as activism. So what I'm trying to do through the real estate projects that I work on is enhance two different sets of people's lives. Number one, the investors, because we make a very nice profit on the work that we do. But for me, it's not just about the bottom line. It's also about that second set of people, which are the residents, the people who live in those properties. It's important to me that we enhance their lives as well. I know that there are some investors who are able to, for lack of a better term, they're like slumlords. They cut back on expenses, which makes profit for them, but it doesn't enhance the lives of the people. And that's something that is really important to me. I actually just had an article in Forbes a couple of weeks ago where I talked about that and how that's really important to me. And I would say to your listeners, those who are passive investors, make sure that whoever you're investing with as the sponsor, the syndicator of the deal, make sure that your goals and your values are aligned with theirs. Maybe for you, it's really just about, okay, I really want to just, what's the bottom line? What's that dollar amount? Maybe that's the most important thing, which is perfectly fine and an acceptable way to go. It's not the way that I choose to do business. But, different strokes for different folks. And so we're looking at different properties like that. I have a property right now under contract, but as most of your viewers probably know, I do my deals under a 506B, which does not allow me to advertise. So I can't really talk about any existing projects that I have right now where I'm in the middle of the acquisition. but I can talk about all my previous deals, which I'm happy to do. And we
Yeah.
just closed on a deal most recently in Dallas, in the northern part of Dallas. It's a 419 unit property. And we have, we're repositioning the property, and we feel really good about it. We've been in operation for a couple of months now, not even quite 2 months. And it's going really well. And we're looking to, improve the quality of that community. It was a unique asset, built in the 80s. It had almost all original interiors. Like, there was one unit.
It was classic.
One unit.
Is the word.
They had one unit they upgraded, and that's the one they took the pictures of. But that's really presents a wonderful opportunity for us.
Perfect for us.
Yeah, because we can go in there and upgrade them, and we may, we may go ahead and upgrade all of the units, or we may only upgrade maybe, let's say, half of the units, depending on how the market develops in the next couple of years. Or maybe we only do half of the units, and then there's another half of the building for the next person to come along. I mean, I think one of the important things to keep in mind, both as a active investor, as a syndicator, right, but also as a passive, you want to make sure that whoever you're investing with has this, that they're thinking about, okay, who is going to be that end buyer, and is there going to be, meat on the bone for the next guy? Because if you go in and you renovate 100% of the units and you burn off all the loss to lease and everything's running and humming along, who's coming in to buy it? On a 400 unit or 300, larger type multifamily, you can have an institutional buyer who would come in and be your end buyer. But if you're buying like 70 units or 100 units in a tertiary market, and you do all the improvements and you've kind of eked out every penny, that might be the type of deal that you're looking to just hold forever, which is fine, and just cash flow. But if you're looking to have do sort of like a value add and a sale, if there's no meat on the bone for the next guy or gal to come along, you're gonna have your buyer pool shrinks enormously.
Yeah. I like the way you said that, because we're all reverse engineering for a sale, whether or if you're not a buy and hold forever, and God bless you if you can have one of these deals and hold it for like 20 or 30 years, that'd be awesome. But if you're a syndicator and we're trying to raise capital, and our investors want their money back at some reasonable period of time, 5, 7, whatever years, then we're reverse engineering that sale. So we're trying to figure out, hey, who's the buyer? What are they going to like? What are they going to, how are they going to buy their property? I did on this note, I want to talk more about this deal, right? So 419 doors, value add, 1980s property, so which is really cool. But when I was working with another asset management team, so our partner in a deal that we're acquiring, this is the first time that my eyes kind of open up to what you're saying, which is they were in the office looking at the paperwork, and they go, oh, this property's a mess because paper's everywhere. The tenant's profile, credit profile, employers, it was just everywhere. And they go, when we sell it, we want to make it super easy for the new buyer to come and do their due diligence. And they have all the details, everything to make it easy for them to underwrite it, look at it. And then when we ask for a price, it's all the records are there. And I guess I never really saw it. Like, you probably have this way more often, but man, how many times have you gotten a property and you're trying to underwrite it, and like the paperwork's a mess, and C12,
Yeah. I mean, look, in terms of, our acquisitions, we've been pretty fortunate. The McCallum deal was pretty smooth. There was that Dallas deal. And our other transactions have been good too. I do have one though, where we bought it and we went into due diligence and the files were a mess. And we knew we were going to have problems. I mean, we could tell right off the bat that this was going to be problematic. And guess what? It was. There was a lot of problems, and our occupancy went way down after, when we bought it, it was almost 100% occupied, and it went down to like almost the 60s.
Wow.
Because there were so many people there who shouldn't have been there, who weren't just, not unemployed, or, were not making, and it was not we still own it. It's not a fancy property by any stretch of the imagination, but they weren't qualified to rent. And, you know, we went in there wide open, with eyes wide open, because we do conduct really thorough due diligence.
Yeah.
But yeah, our thought is that for the next person, when we go to sell it, we're cleaning up all the records, we're cleaning up the property, it's starting to perform really well. It's really turned the corner.
All right.
But yeah, I mean, that's something that happens often in terms of like looking at deals and underwriting. You know,
Yeah.
I always get these like off-market deals from some broker. It's like, oh, I've got these off-market deals, and then it's like, okay, I need an OM, and I need, you know, my T12. I need a T12, right? And for those who don't know what a T12 is, it's just the trailing 12 months of operation. It's your profit and loss statement for the past 12 months broken out by month. And so I'm like, I need a T12, and I need the rent roll, right? And then I need the offering memorandum. And often, because it's off market, you know, there's no offering memorandum, which is fine.
Yeah.
But the T12 is like a mess, or it doesn't exist, or they don't have a rent roll or whatever. And I can't, it's impossible to underwrite deals like that. And then I have heard from some people, they're like, well, we won't give the financials until we have, you know, an LOI and proof of funds. And I'm look at them and I'm like, I've bought, you know, $40 million property without proof of funds. I syndicate my deals, but I have reputable agents and brokers at large brokerage firms who will actually vouch for me if you would like. But I'm not putting in an LOI without looking at the financials, because, you know, when an LOI, which is a letter of intent, right? It's something that just, I'm not sure the level of everybody on the, on
this is good.
This is
Yeah,
the podcast.
you're explaining well throughout it. Yeah.
Okay, good. The letter of intent is something that that you will present to a buyer to spell. I'm sorry, the buyer will present to the seller to spell out the basic terms of the deal, the purchase price, the due diligence, you know, a few different types of deal points to make sure that the buyer and the seller are in an agreement. And the whole purpose for that is it's not legally binding. Or at least it shouldn't be. You should always have at the bottom of your LOI saying it's not legally binding, but it should spell out the deal terms. So then when you go and you hire a lawyer to actually write up the contract, well, the clock is ticking and the bills start piling up, and lawyers are not cheap, at least not good ones. So you can spend, you know, $5,000-$10,000 and more just writing up your purchase and sale agreement. So if you're not clear on the terms and you don't have sort of a meeting of the minds between the buyer and the seller, you can spend a lot of money unnecessarily. So the purpose of the LOI is to do that. But for me to present an LOI to a buyer without having seen their financials, I mean, I don't know. I could pay $5 million for your property, or I could pay $50 million. It depends on the I don't know until I've seen the financials and I understand what's going on. So it's almost pointless, because whatever I put into that LOI inevitably will have to be changed. You know, numbers could go up or could go down, and I'm going to be spending thousands of dollars, maybe tens of thousands of dollars, getting a contract written without a real agreement. Because what's going to happen is, you know, we're going to get into a PSA, then I'm going to go into due diligence, then I'm going to get to see the financials. It doesn't make sense, because then we're going to have to retrade on the deal usually. And usually I have found that if they're doing that, it's because there's a problem that they don't want to let you know about.
Yeah,
right?
There's some kind of trend. There's some kind of trend buried somewhere in there. Then you're like, hey, they don't want to see it's trending down, or the expenses are trending up, or something funny. Like, no, we don't have all that stuff. Or like, anyways, yes, yeah, I agree.
So when the financials are a mess, like you were saying, it can make things challenging. Now, I've heard a story though, a guy that I know that he got a deal. And he got a deal off of LoopNet. And a lot of people will make fun of LoopNet and say like LoopNet is where deals go to die. And I think probably for 99% of deals, they may or may not be right. I haven't spent too much time on LoopNet. But this guy found a deal that had been on LoopNet for like over a year. And once he dug into it, it was a you know, mom and pop ownership, right? And they just didn't keep good records, and they didn't really know exactly what was going on, and he had to like work with them, and he worked with a lender and was able to sort of like recreate their finances, and it was a lot of effort. It ended up being an amazing deal for him. I mean, he took it down, he did great renovations, he sold it, and he made a ton of money. But there was
Yeah.
a lot of work that had to be done up front. And it was I believe it was his first deal, so he was
Yeah.
willing to put in sort of that legwork. But I think for the most part, when the financials and things are a mess, you're going to have problems getting financing too. So
Yeah. Think of your end buyer, make it easy for them. It's probably easier for you to get all the money that you want. And that was your original point was like, wow, you've gotten a 419 unit deal, one property, everything else was classic is the word that we kind of end up hearing.
yep.
Classic, just for those that are not doing the deals regularly, that just means it's old and they haven't been renovated in like 20 years or something. There's classic, but you've got a lot of, like you said, opportunity and to force your appreciation up, do the interior unit upgrades, and then increase the rent, but still leave something for the next buyer to look at, because that's what we want to do. We want to buy a property where we can force the appreciation up, right? Hello. You're listening to the Five Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review and we're going to send you a free copy. So thank you so much for subscribing to the Five Talents Podcast. We really appreciate it. So tell us about your deal, man. That's awesome. How did you maybe walk us through kind of a, kind of start to finish this? Like, how did you find it? Broker, I'm imagining, and then how much capital did you raise, and what when are you guys starting the work, and kind of hold just any of the details you feel comfortable sharing.
Yeah, I mean, we've closed on the deal, so I don't have a problem with talking about the details on it. That deal is based in Dallas. I live in Boston, Massachusetts. And so I don't buy anything here in Boston. I mean, Boston's a great market, real estate market, for a number of different reasons. There's so many different economic drivers, and for preservation of capital, this is a wonderful city to invest in. If you've got $10 million and you just want to buy like one property and hold it forever, I can't think of a better place to do it. But if you're looking for value add and to like grow your wealth, I don't think Boston is necessarily the best. At least there are some new construction deals that around here that make things interesting. But in terms of the sort of buy and hold, like buying a large multifamily and repositioning it, it's just the numbers don't work up here. So for me, I have to go anywhere. And so, there's two areas that I tend to work in mostly. One is Kansas City, and then the other one is in Texas, and in Dallas. And we've also been looking at things in Houston as well. And I have a few different partners that I work with. And those are partners that I've met over time. We've done deals together. I've invested in their deals. They've invested in my deals. And, it's sort of almost like almost an incestuous relationship, right? Just because of all the sort of ways that we've worked together as partners on things, which is kind of a good thing about me. You mentioned, I think that I have a very large amount of doors, but 75% of that are deals that I'm passive in. So I've invested in a lot of people's deals and gotten to know people that way. And 25%, the other 25% are deals that I syndicate or that I own. There's some that I just own on my own. So, for us, it's really about going and picking those particular markets and developing the relationships with those brokers. The property in Dallas, the McCallum deal, we had a really good relationship with the broker. We bought deals with them before. Well, I hadn't been involved in that, but some of my
Your
other partners had
partners.
bought deals with that person before. So that created a certain amount of credibility. And we really liked the deal. You know, we took a look at it and we came in pretty aggressively on it because we really liked the deal and we were able to take it down without too much problem. But the one little hiccup though was this little thing called COVID. So, you know,
Yeah.
we were looking at this deal and in negotiations on it in February, towards the end of February. And then, you know, March came around and we were just about ready to sign PSA. And we were like, okay, time out. let's hold on a second, because, you know, we didn't know what was going to happen.
Yeah.
You know,
Yeah. At the beginning of March, we didn't know if it was like, if it was going to, we didn't know which direction it was going to head. And obviously, even the direction it headed was horrible now, but it could have been way, way worse. Right. So anyways, go ahead.
Yeah, I agree. We didn't know what was going to be the outcome. I mean, the outcome for you know, the country and the planet and society obviously has taken its toll. From a real estate, multifamily real estate perspective, it really hasn't been very bad at all. But we didn't know, so we immediately halted all distributions on all of our deals. We then started them back up this summer and actually gave that earlier distribution plus the second quarter distribution as well, because things were fine and it was. You know, our investors thought it was smart. What we did was prudent to let's just take a pause for a moment and see how things shake out. But things so far have been
same.
good.
We did the same.
I think everybody. I mean, I have a lot of passive income from all the real estate deals, and it's like, you know, it's like the faucet turned off. You know, for 3 to 6 months there, and then most syndicators. I think every deal that I'm in now. Thinking about it, I think every deal except maybe one or two have restarted the distributions, which is great.
Us too.
And so you know, we put a pause on this thing, but then once we saw where things were, we got to the summer. It had been, you know, about 3 months, and things were good. We looked at the T3. We were able to re-engage with them, and we did we negotiated on the pricing. We actually. It was a $40 million deal, so we ended up paying $39 million for it, which is not, you know, $1 million is not shabby.
Yeah.
But I mean, it's not all that in the grand scheme of things.
We'll take it
on a price point. Yeah, well, on a $40 million price point, it's not that much, but yeah, it's something. Yeah. And, you know, we raised, I think a little over $11 million in capital. And we were floored by the response on that deal. When
did it actually close, Matt?
About a month and a half ago.
Okay, got it. So you had it under contract in February. We kind of cooled off. Your buyer gave you.
Well, it wasn't in. We were in negotiations. We paused it in March. Then we went back in. Right. It was right around. I mean, sorry, I don't have the exact dates in front of me, but it was right around Memorial Day when we went back into when we went into contract, and we closed shortly after Labor Day. It was something like that.
Well, you know what?
So in September we closed.
You know, I'm definitely not on you know, the level of raising capital and talking to investors probably that you are, and with your background and experience. But on my level, I kind of experienced the same, which was everyone tightened up. On a couple of deals that we had, we actually, you know, walked away from a couple of our teams that I'm involved with. And then the investor capital kind of felt like, I think for any passive investor that's listening, you're probably thinking the same. In March, you're like, oh, I got to conserve. I don't know how to put this out there. But then, you know, come June, July, August, it's like, oh, end of year, I got to get this money out. I'm sitting on too much. And hey, what deals do you have? And, you know, that's kind of what we experienced, at least on my level. So it sounds like you guys were, you know, could raise $11 million on the 39 million buy, and people were probably grateful for that,
Well, not
having the
only that,
avenue, right?
we were shocked at how quickly we raised the capital. We filled up in 48 hours,
Two
which blew
days.
our minds. But
uh,
I think there was a number of factors. I mean, number one, I think our current investor base, likes us and our deals perform. So I think that
yeah,
that was part of it. But I think, the fact that there, like you said, there hadn't been a lot of deals, everything had kind of frozen up. Not just, there just wasn't deals out there.
at
And
all. Yeah,
so there wasn't a lot of opportunity. And also, I think people started to feel like the stock market was looking really frothy. I think it's still, we're recording this in
yeah,
October, and it still looks pretty frothy to me.
yeah.
Dow's like at like 28,000, and it's just, with all that's going on in the economy, it doesn't seem to make sense to me. That's why I don't really invest very much in the stock market, because I don't I don't
Yeah.
get it. But
Yeah.
I mean, I get it, but I don't get it. So that that is what it is. So raising the capital was pretty simple. And then we proceeded to closing. There was no surprises. Due diligence went really well. We got our loan. We got an amazing rate. I mean, we got, it was below 3% interest rate, which is like incredible. And so we closed, like I said, in September. And so, we have weekly asset management calls, of which I'm a big part of. We're doing all kinds of things. We did a cost segregation study, which actually came out better than we had even anticipated it would, which is
What
going to
what
make
was the percentage for like that's write
it's
off or
yeah, it's about 95%
oh my
of
gosh.
what people of the invested
Let,
capital.
let me pause on a
Now,
few things. Oh, before you
yeah,
keep
go
going.
ahead,
So
go ahead,
let's
go ahead.
pause at a
No, no,
couple
no.
things.
I just want to make sure that like people realize like the passive loss rules, which is maybe what you're going to get into.
Yeah, yeah, yeah. So, well, there's a few things. So, as a passive investor, right? I try to educate, as many new investors as possible. Get education now, today. If you're not investing tomorrow, you need to invest in your education today, because the more you know today, when these deals pop up in your inbox, because we had the conversation with me or Matt or whoever, other general partner, when they hit your inbox, you have to be prepared sometimes to move very quickly. And if you haven't done your education in advance, it will feel very uncomfortable to try to make this decision in 48 hours to get into an investment. So if you do the work now and prepare for the future, you don't know if the deal's going to, get under contract tomorrow or next week, next month, but the more you prepare for it, the easier it is to, pull the trigger and make the decision to invest very quickly. So if you're a passive investor, that's the reason I want to talk about Matt's book before we go to. He's got a good book coming out. I've got one on passive investors. He probably puts a lot of content out there. I've heard his podcast. There's a lot of things to try to educate investors, as do I, so that you can prepare yourself now. And the second thing that I want to hit on was the passive losses, right? If you are, where I think you're listening, if you're a tech or sales, or I'm going to talk about real estate a professional minute, but if you're a tech person and you're making a high W-2 income and you have a spouse at the house and that spouse is not quote unquote working, they should absolutely try to be a real estate professional. There's a podcast interview that I've recorded recently that talks about material participation and try to be a real estate professional so you can take advantage of these losses. Matt, tell us what this passive loss means. What is 95% cost segregation study? What does that mean to me if I put 100K in your deal?
Yeah. So, like you said, it depends on your status or your in terms of how your taxes are done. So this is something that I would always tell people. I always tell people, talk with your tax preparer about your particular taxes, because your situation may be different.
Mm-hmm.
But I'll give you a general understanding of what I understand, which again, check with your CPA, right?
Yeah.
So if you're a real estate professional, that there's certain criteria that you have to hit from that the IRS makes sure, and I'm sure you talk about it in your podcast, like you have to have worked 750 hours a year doing it, you have to document it. It's not like you could just be like, oh, I'm a real estate professional, because if you get audited, you can get in big trouble. But if you can legitimately substantiate that you're a real estate professional, you can write off the entire passive loss, because it's no longer a passive loss. It's actually considered an active loss, because that's your job. So for me, if I invest $100,000 in somebody's deal, whether or my own, whatever, and I always invest in my own deal. So, well, let's talk about the deal in Dallas. I put $100,000 in that deal. And so what I'll get at the end of the year, early next year, when it's tax time, I'll get a K1. And so the K1 is a tax document that you get as a passive investor. And that document you use when you file your taxes, and it shows on that document any profits or losses that you have. Well, because of depreciation, which we could talk about also, but exactly what depreciation is, but because of that depreciation, I'm going to have a $95,000 loss on paper. So for my taxes, it's going to look like I lost $95,000. Now my wife has a W-2 job. So let's say my wife made $95,000 in her job and she paid taxes throughout the year. Well, when we have this K1 that shows a $95,000 loss, it actually makes our income zero. And so all those taxes that she paid throughout the year on her paycheck, we will get as a tax refund. But let's say she made $200,000 a year. So that 95 would just make her thing from being 200 to being, 105, and she would still owe less taxes, and we would get that back. So that's how that works, in terms of, that's because we're married and we file jointly. If I was a single person, the same thing. Let's say I had a W-2 job, but I invested passively. If my W-2 job was real estate and I was a real estate professional, I'd be able to do it. But if I wasn't a real estate professional, there are rules that limit the losses. But generally what it is your passive losses can only offset your passive gains. So let's say we had distributions this year. Well, it doesn't matter distributions, it just matters gains. But let's say the company I made $10,000 based on the performance of the property this year. But I have that $95,000 loss. So it means that $10,000 gain, I don't pay taxes on that. And then there's a remaining $85,000, but I don't lose that. That just sticks around in my tax forms.
It kind of just carries over to the next year, whatever you want to use,
and then
it carries over again.
I can use it. And the following year, there will be also more depreciation, but not at that level. It'll be much smaller. So generally what happens on these syndications is you're usually not paying taxes on your cash on cash distributions. Now, at the end, when there's a sale, if you're making profit, then there's taxes, and some of the depreciation may need to be recaptured, but oftentimes the recapture rate is lower than what you would have been paying if you had paid the taxes 5 years ago, plus you had the money for 5 years. So there's a number of reasons why investing in real estate can be tremendous from a tax savings perspective.
Yeah. And then I always hear those last points. Well, what about recapture? What about the capital gains? And what about, I'm like, why don't you just invest in another deal when your deal sells, and you can start the process all over again? And but anyways, it is amazing. That's kind of how I originally, really got turned on to multifamily syndication, was this right here. Because I, realized the biggest expense that we have in all of our lives, it's not our mortgage, it's not your car, it's not whatever, it's taxes. The biggest expense that you're ever going to have for your entire life is taxes. So if you have a strategy on which to make income on one hand and reduce taxes on the other, you've just, solved one of the biggest issues where people say, oh, yeah, death and taxes. I'm like, yeah, well, death is for sure, but there, taxes can be debated a bit if you have the right strategy and you're doing the right investment. So it's pretty freaking cool, man. Just thought I'd pause there for all the passive investors. Now, that deal you mentioned, sub 3% interest. What kind of loan did you have? Was it a non-recourse agency? Was it a stabilized property, that kind of thing? Or
100%. That's exactly what it was. We almost exclusively deal with agency debt. This one happened to be a Freddie Mac deal. It's non-recourse. It's a 10-year loan. assumable, yield maintenance, prepayment penalty, 3 years of interest only at the beginning, which I think is good. I mean,
Yeah.
it's nice to pay down debt over time. So, but for the first couple of years, I think it's really nice to have some interest only. I mean, it makes the cash on cash a little bit nicer, but it's really about sort of from a cash flow perspective, because on all these deals, we're doing value add. So we're repositioning, and there's a large capital outlay that's involved in doing that. And you're putting out the capital, and then you're a lot of times well, in the Freddie deal we didn't, but a lot of times we're doing Fannie deals where we actually get a lot of the rehab dollars financed, which is really cool. But you then have to, they're held in an escrow account. And you have to fill out paperwork and send it in, and it has to go through approvals and inspections, and it takes a long time. So as you're doing like a repositioning on these deals, if you're doing a value add, it's nice to have a couple of years of interest only just while you're doing that. Like, for example, in that deal I was talking about, where we had just a ton of tenants that were just unqualified to be there and ultimately left, or sometimes we had to evict them, unfortunately. We try to work with people as much as we can, because we're all about enhancing the lives of the residents. But if they're not gonna be able to pay, we have to figure something out. But anyway, while all of that is happening, if you're only paying your interest and you don't have to pay down principal for the first couple of years, it just makes things a little more comfortable until you get to a point where you're really stabilized a couple of years into the deal.
Agreed. So in addition to what I do as an investor, I'm also a commercial loan broker for Peak, and I've now that I'm on this side, I'm like, whoa, I really try to take advantage of the best possible products for all of us. And so anyways.
Is that with Anton Peak?
Anton Matley.
Yeah. Oh, he's great.
I work directly under him and just started this year. I've been enjoying kind of flexing my underwriting skills a little bit more and learning more about the finance. So it's been really cool. And then kind of see a lot more deal flow and help my partners and friends. So
cool.
I'm excited. So before we go, man, I had such an amazing conversation. I've probably gone over time at this point. I'm looking at this timer. I'm like, oh, this is so good. I have to let you go. A couple more things.
Yeah.
Where can our listeners reach out to you? They want to get in your world. They want to, invest in the future. They're trying to learn, just more about the whole thing. Something resonated with them about you. Where's the best place for them to reach out to you?
Yeah. So you mentioned earlier, I have a book that's coming out. And so we're going to be doing a big launch for that and giving away books and all kinds of stuff like that. So if people want to get involved in that and get a free book and whatever, you can go to my website. It's mjppg.com. I've got pg.com. I've got a newsletter sign up on there. There's a contact page, so you could definitely sign up for the newsletter and start getting information. You can also reach out to me by email if that's easier for you. You could just email me. It's Matt, M-A-T-T, at mjppg.com, right? Just like the website. So I love talking with people, passive investors, active investors, zero experience, a lot of experience. I love chatting with people. And like I said, I think this book's going to be really cool because it talks about my background.
What's your book about?
I think you mentioned, I have a background in theater, and then I was in digital marketing for 18 years in New York City. So I tell all these stories about my background and then how I started dabbling in real estate as a hobby, which I did for about 10 years. And then I started becoming a full-time investor for 5 years. I've been doing that now. And, first it was only passive, and then I started getting more into the active. And so it's got some really good things. And I think, real estate skills and techniques and tools that are taught in there that will be excellent for passive investors. And I think people who are a little more experienced or active investors will probably get a couple nuggets of wisdom from that as well. But also my story is kind of really unique. So I think they'll find it an enjoyable book.
Man, that sounds awesome. When is it coming out?
Well, we don't have a publication date yet because we're still talking with some publishers. It'll be in early 2021.
Okay.
So, but I don't have a date quite yet, but sign up for the newsletter if you're interested, because I'll definitely let you know at that point.
Oh, that's great. It'll be good timing because I think this will probably come out. We had a number of shows recorded. We're pushing them out daily right now. I don't know if that pace will continue forever, but your show will probably come out. Our listeners will listen to us today, probably at the end of November-ish. So right
Oh,
around
great.
Thanksgiving, Christmas, and then you guys in time for 2021, the new year, start off with this new book. I'm sure it's gonna be amazing. I'm gonna pick up a copy, that's for sure, and I'm excited about it. And your background, you were an actor, Broadway musicals. Just hit on this a little bit, man. That's so
I
interesting.
moved to New York City to pursue a career in theater.
That's why
And I
you're in New
did that
York.
professionally for 5 years. And then you fast forward, and I met my wife, who happens to be involved in theater as well. And actually, one of the things that my wife works full time in the theater. She runs she's general manager of a theater, a really big theater here in Boston, Massachusetts. But she was on Broadway for a gazillion years. And one of the things that her and I do together is we work on Broadway musicals. We invest, and sometimes we're like general partners in those deals. Co-producers is what they call it.
Are they syndications?
They're syndications.
Also? Wow.
Yeah, they're actually
That's
syndications.
Really cool, man.
Very similar. They're basically a 506c.
Wow.
And so we've been involved in some shows that have done really well.
Uh-huh.
We've also lost money, right? But our wins it's super risky, but our wins have done our losses, so it's great. Actually, we have a show that we were involved in called American Utopia, which is going to be on HBO starting October 17th. So you said this comes out at the end of November. It should still be on there. It's David Byrne, the guy from the Talking Heads, and it was directed by Spike Lee. And
wow.
It's really cool. So people can check that out. It's on HBO.
Wow, that's super cool, Matt. Dude, there's all kinds of interesting nuggets about you, man. A lot to uncover, and I know we didn't get to nearly as many things as we want. I'm gonna have you come back and maybe talk about some more of your experiences, brother.
Anytime. Thanks for having me on.
Yeah, thank you very much and appreciate it. And is there anything else that I didn't ask about that you really wanted to highlight or hit on?
I don't think so.
All right. Well, very good. My name is Abel Pacheco. I'm your host for the 5 Talents Commercial Real Estate Podcast. And if you heard something today that brought you some value, leave Matt a note, go reach out to him, provide us a review on our podcast, leave us a rating and written review on what you liked. And if for some reason you didn't, I don't know, leave us some feedback on how we can improve. I thought this was a great show though, Matt. So I'm excited,
awesome.
Brother. Thank you very much. Thanks. And thank you guys. We'll see you soon. Thank you for listening to this episode of the 5 Talents Podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who follow their dreams and achieve massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents Podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked, tell us your favorite guest, give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents Podcast.